I'd like to thank our attendees for joining us. We know that you have your choice of several webinars. My objective at the TOLI Center East as a managing partner is to basically have a client better understand their life insurance, their long-term care insurance, and to make certain that they're maximizing and getting the maximum value for it. My objective today here at NYC is to share my 35 years of experience, both as a practitioner and as an author, focusing on the subject of traditional long-term care and the new combo plan that combines life insurance and long-term care with some tax benefits thrown in. So that said, let me go to our agenda. Okay, so we're going to be talking about a couple of things in the next. One is primarily matching and selecting a death benefit or a living benefit, because unbeknownst to many people, policies contain both. We'll talk about the history of long-term care insurance and the industry as a whole. We'll talk about what does long-term care cover, what does it not cover, how does it work, how to apply for coverage, and also how to apply for claims. We'll talk about some of the current trends and issues in the industry today, as well as the various types of coverages that are available. We'll also talk about the PPA, which is the Pension Protection Act, which basically initiated the combination of living benefits and death benefits into the linked benefits that we'll be speaking about as far as covering for long-term care insurance. Also touch on the corporate and tax credits as well as benefits of long-term care insurance. And of course, we'll talk about the combination plans in coordination with ILIT ownership. So my first objective is to match policy with their individual client objectives. Life insurance is an asset class. It's not just a death benefit. Purpose of this slide here is just to show that there are various types of policies. If we look on the left, we see term, universal, non-guaranteed, universal guaranteed. We see that there are various products that are guaranteed, various products that are not guaranteed. That's on the death benefit side. And the objective there, of course, is to provide the maximum death benefit. If we go down to the second half of the screen, we see that it talks about policies for maximum living benefits. And there again, we look at a different array of products, including the whole life or the indexed universal, variable universal. It's not my intent to talk about the individual products, but I'm just letting you know that there are different products with the different features, guarantee, non-guarantee, that are used both for either for living benefits or for death benefits. The purpose of the living benefits is to be able to provide tax-deferred growth and accumulation, as opposed to the life insurance side, the death benefit, which is to provide maximum death benefit. So under the death benefit, excuse me, under the death benefit, we see that we have, for example, being able to provide a family income, being able to use the death benefits for paying off debts, or many people use life insurance to cover their future estate tax liabilities. For those of you that are familiar with the Secure Act, we also use life insurance to pay the future tax liabilities, since now at this point, various beneficiaries are no longer able to use the stretch IRA. So we now have, or various individuals now have, a future tax liability, and life insurance is a very good asset to be able to use to pay for those. Of course, it's used to provide educational funds for kids. It's used to fund buy-sell agreements for business partners. And last item that I have under the death benefit for traditional death benefits is to be able to provide legacy gifts to the next generation. Under the living benefits, the two highlighted areas that I'll be talking about today is to be able to use life insurance to pay long-term care costs from the death benefit of the policy, income tax-free, as well as the interchange, the interaction with life insurance, long-term care insurance, and annuities. There are two other areas for living benefits that we won't be covering today. I'll just mention them briefly. One is to be able to use the living benefits to be able to supplement an individual's retirement with tax advantage payouts. And the last living benefit is to provide an alternate exit strategy for a life insurance policy. Sometimes life insurance policies are no longer needed. and the ability of using life insurance as a life settlement to be able to sell a policy while one is alive and for the owner to garner the benefits rather than the beneficiary. So life insurance, as I said, can provide a living benefit to the insured. It's used to provide the combination hybrid and linked policies that I'll be speaking about. It's used to provide to be able to obtain gains on an annuity with a tax-free basis. And as I mentioned, it's also used to supplement retirement, and it's used as a life settlement where one can actually turn a bill into an asset. And as I said, that benefits the insured, not the beneficiary, because he or she can then obtain a higher payout than if he or she were to just turn the policy back over to the insurance policy, to the insurance company for its cash value. So a quick word about long-term care today. Long-term care, from a personal point of view, I can tell you that it provides independence, it provides privacy to the individual, and certainly provides a certain degree of dignity for an individual when things are not at their brightest or shiniest. The care coordinator is an individual who takes care of an awful lot of the administrative details that usually a spouse, a daughter, and a family friend, very good family friend, might do and might take care of. But the point is using long-term care allows an individual family member to be cared about as opposed to cared for. And certainly the advanced planning that Aaron will get into in a little bit can certainly avoid a family crisis. There's certainly significant tax benefits and tax credits attached to these long-term care interests, simply because the government wants to incentivize people to purchase their own long-term care rather than relying on the Medicaid system. Employers can discriminate. It's one of the fastest growing employee group benefits. That's group long-term care insurance. And although in a few moments I'll discuss some of the problems, let me start by saying that in 2018, the Society of Actuaries issued a report, and they basically said that premiums today are stable and that we don't have to be concerned with the significant premium increases that we had in the early 2000s, even mid-2000s. Reserves are also sufficient to be able to pay claims. So they've given us a clean bill of health. I'd like to read this because this is was the basis for some interesting aspects in the subject of long-term care that I brought to bear. Let me just take a quick moment. An unexpected, unreimbursed long-term illness can have catastrophic effect on one's personal life as well as that of their family. Arrangements that people make or don't make while they're younger and healthy will determine the quality of their and their families' lives going forward. Those that plan ahead will avoid having to deal at that time with the financial and legal issues on top of the ever-present medical and emotional issues, and can avoid a significant family crisis. That was written for the Money paper back in 1985. I took that information as well as the information that I garnered on the subject of long-term care, and I approached the New York State Bar Association back in the fall of 1986. That's a full year before NAILA came into existence, and 2 years before NAILA even reared its appearance here in New York State. I called the program Advising Clients on the Infirmities of Advanced Age. After my program, there were 4 attorneys in the room. I might mention that 3 of which later went on to become presidents of New York chapter of NAILA. And one of them said, "Hey, you've got a good idea here, but why don't we call this elder care?" And I've called it elder care ever since and got rid of the Advising Clients on the Infirmities of Advanced Age. So let's talk a little bit about the history of long-term care insurance. One, because the aging population and modern pharmacology being what it is, certainly created a growing need of services. The age 80 is the fastest growing segment of the population. Back then we had what I call, well, no, let me give credit where credit is due, where Vince Russo called it the roulette wheel of illness. If someone came down with a cardiac condition or cancer or brain tumor, or God knows what other diseases, Medicare was there. But if an individual came down with the wrong illness, um, Parkinson's, multiple sclerosis, Alzheimer's, individual was on his own. So as a result, various elder law attorneys began developing various strategies. I call them basically showing individuals how to artificially impoverish themselves and qualify for Medicaid. The use of long-term care fit in very nicely with plugging up some of the risk so as to not have an individual be responsible for 100% of the risk. If an individual had a 3-year or a 5-year look-back period where they were not qualified to obtain the coverage, then perhaps they could use a long-term care insurance policy to cover them for that 3-year or 5-year penalty or look-back period. Or, of course, they could continue that 3 or 5-year benefit and use it as ongoing coverage. Medicaid raised its penalty period from 24 months to 36 months to 60 months in an attempt to prevent people from going on Medicaid. Back in the days where Hillary Clinton was not a candidate for president, but she was the first lady under her husband, President Bill Clinton, she took painstaking effort to try to have Medicaid pay for that long-term care bill. But back then, in the early 90s, the Medicaid bill for long-term care was upwards of $90 billion. And that's when $1 billion meant something. Today, we talk about billions of dollars the way that we did years ago about millions. But it became unattainable to have Medicaid take the responsibility. And as a result, they began the formation of the New York State Partnership to help solve the problem. New York State Partnership was a joint effort between the insurance companies, the state government, and the federal government, again, to try to encourage people to purchase some form of coverage for a short period of time. But if they had that coverage, they would then qualify for Medicaid, even if they had more than they should have had. It was a ticket to have Medicaid pay the bill. All they had to do was cover themselves for the first 3 years with certain other contingencies. Then they came up with something called the Class Act, which was, again, another effort, but it did not work because they simply did not throw enough money at the problem, and the problem kept getting bigger. Then they came along with the Pension Protection Act, which I'll be discussing and speaking a little bit more about as we move into the program. And most recently, something called the Washington Project, where the state of Washington, in an attempt to relieve their Medicaid roles, is mandating that people spend a small amount of money on a monthly basis directly from their payrolls to be able to purchase a small amount of long-term care coverage. It's $50 a day. Perhaps that might be useful in Washington, but it's certainly not very useful here in New York, and I don't expect that to become a significant answer. Managing risk. If you or your clients are the type to pay homeowners insurance, even when their house is paid up and there's no legal obligation to maintain homeowners insurance, or to maintain auto collision, even when there's no loan on car, and again, there's no mandate that an individual must have collision, where there's a total loss is less than 2% to 3%. I'm pushing it when I say 5% of homes being destroyed to the point where it's a total loss, or where cars are destroyed to the point where it's a total loss. Those are the individuals that are most likely to want to protect against unexpected, unreimbursed long-term care expense, where the odds are 75% plus of occurring by age 80, with a significantly higher after-tax dollar loss exposure. I think this basically states who our market is for looking for this protection. what is the protection? What is long-term care insurance? Well, let me start out by tearing down a contract. Daily benefit today is anywhere from $100 up to $500 a day. The duration is from 2 years up to today, 7 years. Years ago, it used to be lifetime benefits, and it was priced incorrectly, and people were buying up lifetime benefits like they were going out of style. There's a waiting period similar to a deductible on car insurance. You perhaps might have to wait the first 90 days or 100 days before the benefits start. You can have that knocked down to a 0-day or a 20-day, but I also remind my clients that Medicare may pay for the first 100 days. So let's use what we can from Medicare and push that waiting period up to a 90-day period or 100-day rather than starting off with a higher premium for 20-day. There are all sorts of inflation options, 2%, 3%, 4%, up to 5% simple, or up to 5% compound, where the daily benefit increases each and every year. You're paying for that up front, so your premium does not increase because the benefit is increasing as a result of inflation. But I might add that inflation makes up approximately 50% of an individual's annual premium. So we'll talk about how to qualify to purchase long-term care. And in my next slide, I'll be talking about the underwriting. Let me just get back to this sheet before I move on, this slide before I move on to the next one. Talk about how to collect benefits. If an individual is unable to perform 2 of the 5 activities of daily living, eating, bathing, dressing, transferring, toileting, continence, then he or she is eligible to collect benefits. Even if an individual can do the five activities of daily living, but they have any sort of a cognitive impairment, senile dementia, Alzheimer's. So even if they can do all of the activities of daily living, but if they have any sort of a cognitive impairment, they too are eligible to collect benefits. Caregiving. Individual can have a contract that only allows professional caregivers licensed by the state that they're in, or for a little bit more money, they could purchase an informal caregiver where they can have a non-licensed family member provide care. As far as the industry overview and the future outlook, it's become stable. In the early 2000s and mid 2000s, unfortunately, people were experiencing premium increases 30, 40, 50, 60%, simply because the prices were marked incorrectly initially. Initially, there were traditional plans, what I call standalone plans. They were not guaranteed. Pricing, as I said, could significantly increase at I don't want to say the whim of the insurance company, because they did have to go to the state insurance department to request a price increase. But if they requested a price increase of 70% and walked away with 30% or 40%, the state insurance department certainly did its job, but they still left the individual policyholder, the insured, with a significant increase in their bills. Of course, in a couple of moments, we'll be talking about the linked or hybrid or combo plans that offered, among other things, in addition to tax benefits, guaranteed pricing. We'll talk about how that influenced people's mindsets in terms of what they thought were valuable benefits within this realm of long-term care. We'll talk about group. We'll talk about individual discrimination rules. Employers, depending on the type of corporate entity, are able to provide a benefit on a deductible basis for all officers, for all presidents, for all vice presidents. And they were able to discriminate and not offer that to the rank and file, but only offer that to a certain class of people. There's certainly various credits, state tax credits. Individual in New York State purchases a policy, and they're looking at a 20% tax credit, not a deduction, but a credit, meaning if an individual is paying $5,000 a year in premium with a 20% New York State tax credit, that knocked that $5,000 premium down 20% to a $4,000 premium. Very meaningful. The difference between a reimbursement plan and an indemnity plan. A reimbursement plan meant that the insurance company would give you back the amount of money based on a bill. An indemnity plan, if you had I'll make up a number, if you had a $200 a day benefit, that $200 a day benefit, regardless of whether you had a bill or not, individual qualified, unable to do two activities of daily living, or had a cognitive impairment, they received that benefit without the need to provide a bill to the insurance company. That's called an indemnity plan. The underwriting process. Don't let anyone practice on you. Make certain that the individual that is talking to you or talking to your clients is experienced, is independent, and is able to determine an appropriate company and an appropriate strategy. This is not just pushing a button. There are various decisions that have to be made, various judgment calls that have to be made. Make certain that they do these things and not really submit an application to the company that they represent if they happen to be an agent of the company. All, very important, all medical history and medications must be disclosed. Any medical history, when you sign an application for an insurance company, you're allowing that insurance company to contact your doctors. They can even contact a organization that provides information on any medications that a pharmacy through any of the various insurance companies may have approved for use. Very embarrassing if someone forgets to list the medication and then the underwriter comes back and says, well, how about this medication for this particular illness? You don't want to be able to get on the wrong side of the underwriter. It's very difficult to fight back from having the perception that you may not have been totally honest, because then they begin thinking, what else might you have forgotten or not been honest about? As I said, the underwriter is authorized to check your prescription refills. An underwriting letter is one of the most important things where your client has their positive points. You only have one opportunity to make a good first impression, and that underwriting letter is that opportunity to put the best foot forward. If a client is exercising or doing things, dieting, has lost weight, has taken steps, Fitbits, gym memberships, all that stuff's important, and all that stuff helps when we're negotiating a health classification for yourself or for a client. Insurance company will set up a 20-minute interview. If there are no medical issues, they'll issue a policy right on the spot. Usually, if an individual is over age 70, there will be some sort of a cognitive impairment screening just to make certain that the individual does not have any significant issues that can be picked up in a cognitive screening where they give you the names of 5 or 6 or 7 items and then spend 2-3 minutes talking about something else and then ask you, by the way, of those 6 or 7 items that I mentioned a few moments ago, how many do you recall? If medical issues exist, the insurer will write to the doctors. Once the info is obtained, it'll be approved at a particular health classification. And at that point, the agent or broker's best efforts really need to be made to negotiate that best offer for that client. Just because the underwriting health classification does not mean that it's set in stone. In many cases, underwriters have been known to change their health classification if they find a reason, or if the agent or broker helps them find that reason. So here's a typical contract. This is for male age 62, female age 58. Both partners are married, so there has to be a partner discount. Both these people were deemed to be preferred, meaning that they take less than 2 medications and there is no significant history, either for themselves or family members, and they have a preferred classification. which is the best classification. Typical contract, again, it's whatever the typical client chooses, up to $500 a day. But for purposes of this presentation, I chose a $200 a day or a $6,000 a month benefit. These contracts are what's known as comprehensive. In other words, they pay for care in a nursing home. They also pay that same $6,000 per month in an assisted living facility. And they also pay that same $6,000 a month for care at home. The elimination period that I chose was 90 days. As mentioned, Medicare may pay for the first 100 days. And please, if you or your clients have any thought that Medicare will pay for more than that first 100 days, that's incorrect. Beyond the 100-day period, individual is on their own. The only other entity that will pay for long-term care is, of course, Medicaid. And as Anne will discuss in a little bit, there are various classifications and hoops that an individual must go through before that Medicaid dollar will become available. In this particular period, the benefit duration was 3 years, 36 months. In this particular situation, I chose an inflation protection benefit of 3% compound that continued on for the rest of an individual's life. By the way, 3% compound is the same as 5% simple. So 5% simple is interchangeable with 3% compound. I chose reimbursement or indemnity plan. I chose reimbursement. It is somewhat less expensive. I'm not a big believer in people making money off of the long-term care contract. It should only be used if and when it's needed. And if an individual has a bill, then by all means, let's cough up the bill and let's get reimbursed from the insurance company, and let's pay a lower premium rather than the higher premium for an indemnity type contract. So in this particular situation, there was a 15% both partner discount. There's a 15% preferred rate savings. Premium for the male age 62, annual premium is $2,900. Female 58, and yes, there are discriminations against females. Females do cost more. Females tend to have a higher usage. So in this particular situation, the premium is the $6,000 less the 20% credit. The net for the client is $5,368 for a $200 a day benefit. And by the way, 5% simple, in 20 years, money doubles. So by the time the male is age 82, he will have not a $200 a day benefit, but a $400 a day benefit. Same for the female 58. So let's talk about some of the insurance industry problems. Initially, they didn't have any history on long-term care. They kind of did one of these, let's see, let's start with this premium. And they did, and they soon found out that they were incorrect with how often people used or utilized these benefits. They thought that people would be surrendering these policies every couple of years, the same way that people did with their insurance coverage. Not the case. 98% of people keep their policies. Only 2% wind up surrendering. Back then, when long-term care first came out in the mid-'80s, as you may recall, interest rates were upwards of 18, 19%. Many of the underwriters incorrectly assumed that, okay, maybe they might not earn 18%, 17%, but certainly they'll earn 12%, 11%, 10%. As many of us know, from the mid-'80s through several months ago this year, interest rates were on a straight trajectory downwards. And interest rates were, for many years, in the range of 3%, 2%, and 1%. And here, prices were based on 10, 11, or 12%. Many companies rushed to obtain the largest market share. Several companies went out on a limb and basically thought of long-term care as a loss leader. let's just get them in. We can always go ahead and increase the premiums later, which they did. However, many of those companies that rushed to obtain market share have since not necessarily gone out of business, especially not in New York State, where we have one of the strongest state insurance departments that did their job to protect. But in several other states, many insurance companies did basically go out of business. That is not the case in New York State, although there were many companies. At one point, I think there were as many as 20 some odd companies that offered products in New York State. Currently, there are less than 3 companies that offer a traditional long-term care in New York State. They led to significant premium increases. They led to bad press. People were complaining. People were writing to newspapers. People were doing whatever they could to try to get some relief from the insurance companies. But all the insurance companies did is they just kept on requesting those rate increases from the state insurance department. And even if they were half, there were still significant rate increases. And it led to people wanting a guaranteed pricing rather than the pricing of just, we'll choose rate increases, as we see fit. So that said, keep in mind that today, people that have long-term care contracts are still getting letters from the insurance company to offset what they can do, what they can give up to offset a rate increase. My suggestion is, if you can afford the couple of $100 additional dollars in premium, pay the additional premium, because you'll never get back the coverage that's lost. Again, many of these people have had coverage for 10, 15, 20 plus years. If they purchased the policy when they were in their 60s, they can never make up that benefit that they've had for the last 15 or 20 years. So if possible, pay the increase. In later years, if you have to, you can consider dropping inflation, as it does make up approximately 50% of the cost. Consider dropping the duration from a lifetime benefit, which so many people took simply because it was offered, or a 7-year benefit, to perhaps a 5-year or a 4-year or 3-year. Don't give up the coverage. Do something that can help you, not the insurance. So with traditional long-term care failing as an insurance product because it was viewed as too expensive, increasing premiums, and uncomfortable topic to discuss, plus people just felt, hey, it won't happen to me, and if it does, I'll just self-insure. And hey, what happens if I don't use it? I'll lose the benefit. And it's much easier to consult with an elder law attorney and position myself so that I don't have to pay for this with my own money. Maybe I can get Medicaid to kick in part of it. As a result, less than 9% of the market, less than 9% of the population has purchased a long-term care contract over the last 25 years. So along comes the Pension Protection Act, which was, as I mentioned earlier, a collaborative effort on the part of the government and the insurance companies that were designed to provide consumer pricing guarantees against rate increases. The combo plans are guaranteed. The premiums cannot increase. It was an attempt to increase private ownership of long-term care insurance benefits. The insurance company would also profit from more people purchasing long-term care insurance, and it would reduce the government Medicaid costs. So for the first time, the insurance industry allowed what's known as a hybrid, linked, or combination life insurance product to pay long-term care expenses from the death benefit, tax-free. I just said it again, to pay long-term care expenses from the death benefit, tax-free, meaning if somebody purchased $1 million policy today and next month, next year, this needed and qualified for long-term care, they had $1 million available that they could withdraw from the death benefit. And they could withdraw that on a tax-free basis. Significant. Whether they call it traditional standalone, hybrid, many carriers eliminated the standalone long-term care policies and instead adopted the hybrid or combination product. The Pension Protection Act prevented premiums from rising 100 to 150%. They eased consumer concerns as to future rate hikes. They reduced insurance companies' risk because more and more people kicked in a premium to pay for that long-term care. They reduced federal and state Medicaid expenditures, and they increased private ownership of long-term care insurance, which benefits the client. It also stopped the most common excuse for not purchasing long-term care, or the two most common: if I don't use it, I'll lose the benefit. Well, under the Pension Protection Act, under the hybrid combo or linked plans, if you didn't use the benefit during your lifetime to pay for long-term care, you have a beneficiary that would receive 100% of the death benefit. Again, tax-free, because life insurance is tax-free, and if it's set up properly, it can also be estate tax-free. The second obvious reason not to buy long-term care is I'll self-insure. Well, it's easier to purchase a life insurance policy and have that act as the payer rather than yourself. In the example that I gave a moment ago, somebody purchases $500,000 or $1 million of life insurance. It's far better to use that $1 million death benefit or $500,000 death benefit instead of coming up with your own $500,000, which, by the way, was initially taxed. And now when that money is withdrawn, there's an additional tax on that. So let's just move ahead. The life insurance industry solution is combined life insurance and long-term care with some tax benefits. So for the first time, insured purchases a combination of life insurance policy. That life insurance policy pays for long-term care costs from the death benefit. $1 million life insurance allows a 2% payout for 50 months or $20,000 a month, or you can have a 4% payout for 25 months for $40,000 a month. And again, keep in mind that all distributions are 100% income tax free. Majority of new policies today contain a chronic care rider where there's no upfront cost, or a long-term care rider where there is an upfront cost. This is important, so let me just take a moment. A chronic care rider basically says, if you need to withdraw the money, if you need the benefit, you will pay an interest charge for that $20,000 a month, $40,000 a month, whatever the case may be. You will pay an interest charge for the use of that money. However, if you purchase a long-term care rider, there is an upfront cost, but there is no cost if you use the policy. There's no interest charge for that 10, 15, 20,000, 40,000, whatever the number might be on a monthly basis. So again, individual has a choice. They can pay for something up front. They can not pay for something up front and use it and then pay something if they need it along the way. Personal choice, no correct answers. And again, as I say, if no funds used to pay the claim, then 100% of the death benefit is available to the beneficiaries. By the way, not everything that glitters is gold. What's the trade-off? A comparison between the traditional or the combo plans must be made. Every situation is different, and it depends on the individual's personal history, their medical history, as well as their individual facts. If they have beneficiaries, certainly that might be a reason to have the combo plan to leave a death benefit. If someone is not interested in leaving a death benefit, then I suggest they consider the individual traditional plans, which, as I say, of course, are still available. Here's an example about the need to compare apples to apples. I say, although it's an attention grabber, comparisons per dollar cost of traditional life insurance and LTC costs must be made because the price of the combo plan alone is not a sufficient indicator. As an example, male age 60, traditional cost for a regular life insurance policy without any riders, $500,000 guaranteed to age 95 is $5,000 a year. Male age 60, cost for $500,000 guaranteed to age 95 is $5,000 annually. For that same individual, traditional cost of a long-term care benefit, which in 20 years is worth $500,000 in long-term care, has a cost today of $3,000. When you add the $5,000 and the $3,000, cost for both is $8,000. However, if that same individual were to purchase a combination plan for that $500,000, the cost is $7,000. Well, gee, $7,000 is less than $8,000, so let's consider the combination plan. Wrong. The $8,000, if you look down the second line, the $8,000 provides a life insurance policy for $500,000 and a traditional long-term care insurance coverage for $500,000. And the $8,000 provides both. Whereas the $7,000 premium for the combination plan provides one or the other. So the question is it worth paying the additional $1,000 to have both, as opposed to $7,000, saving $1,000 and having one or the other? This was just an example. It's an accurate example, but it's just an example to make you realize that you can't just look at the numbers and say, well, yeah, this makes sense. You've got to look at the entire situation, and an analysis has to be made for it to be accurate and in the best interest of the insured. Again, there's nothing right or wrong about a traditional policy or combination. Each type of coverage has their own strengths and individual goals and client situation should determine which is the most appropriate.
CLE code LTC 125 LTC 125.
Benefits for annuities. As I say, there are two benefits here. One is for the long-term care and life insurance, and the other is for annuities. Just going to say that distribution can be made from annuities on a tax-free basis for the first time as a result of the Pension Protection Act. If you look on the left side, under the old 1035 rules, you could transfer life policy to a life policy, an annuity to an annuity, or a life policy to an annuity. Under the new 1035 exchange rules on the right-hand side, you can now transfer an annuity to long-term care, life insurance into long-term care, a qualified life insurance policy into long-term care. There's some significant benefits in terms of the Pension Protection Act, what it did for annuities and long-term care. So a single premium deferred annuity gives us the ability to be able to basically use an annuity and free up some tax benefits that would otherwise be payable before the individual could use it to pay for long-term care. Here's an example. On the left-hand side, we see an individual with a $50,000 annuity. They had a gain of $50,000, which would be taxable. So that $50,000 gain less tax of $20,000 would make $80,000 available from that $100,000 annuity. That's prior to the PPA. After the PPA, on the right-hand side, the basis in yellow, as you'll see, is $50,000. The gain is $50,000. However, if it's used to pay long-term care costs, it is non-taxable, meaning that now $100,000 is available. So the point is, money can be transferred to pay for long-term care costs tax-free, which benefits the insured today. What is an SPIA? A single premium immediate annuity. You give the insurance company X number of dollars, they in turn give you a payout lasting for the rest of your life. You can now use, now that SPIA is partially tax-free. That's what's known as an exemption, where instead of paying 100% tax, you might only pay an 80% tax. But if you have a SPIA, pay a long-term care premium, then the entire payment comes 100% tax-free. Again, the government is trying to incentivize people to buy long-term care instead of long-term care insurance or coverage of some sort instead of going on Medicaid. The single premium deferred annuity, the single premium immediate annuity are all complements of the Pension Protection Act. I'm not going to bother going into the chart. I just explained it. An example of what the total living coverage does for individual age 68 starts out with a $100,000 premium. They turn that into a $159,000 death benefit, and that death benefit can also be turned into a $497,000 benefit, or $6,600 a month for 6 years to pay for long-term care costs. There are a whole host of articles that spoke about this and other strategies that I brought to the attention of the Wall Street Journal, and there were several stories on this product. I see I'm running short of time. I'm going to begin skipping some information. Yes, there are deductibilities. The information is here on your slides. I'm not going to go into each and every one of these for S corporations, for pass-through entities. I'm just going to mention this in closing. An agent or broker's role is to explain all the products, do what's in the best interest of the client, explain all the available strategies, assist client on deciding their objectives, make their objectives clear, obtain necessary data, match the client's objectives, explain the underwriting process and manage the administrative process, and deliver the policy. Current objectives for the consumers: avoid future rate increases, maintain their existing coverage so that they don't have to give up any additional coverage in lieu of premium increases, and they've got to decide on whether they need a traditional or a combination plan. For the insurer, they can increase their premiums, they can decrease their coverage, don't take their offers, and they can return to market and to profitability. The regulators, they avoid having an insurance company threaten them that they're going out of business, and the regulators are happy when they're able to control and not have the price increases. Summary benefits: long-term care riders are no longer taxable. They can be attached to a new life insurance policy. You cannot attach a long-term care rider or a chronic care rider to an existing policy any longer. They did that years ago for the first 2 years. However, today that option is no longer available. SPIAs can be used to pay premiums. Single premium deferred annuities can be made to be 100% taxable rather than the 80% exclusionary ratio that currently exists today. 100% of untaxed gains on annuity can pay for any long-term care expense. A hybrid plan is just a better way to self-insure. It's no longer a use it or lose it. And again, individuals must compare similar costs with traditional or for a combo plan. Yes, these products can go into trust planning, and I think Aaron will touch somewhat on that. For the time being, I'll just say that the book that Barry mentioned a little while ago has an entire chapter on the Pension Protection Act and on traditional life insurance. There are additional resources and articles available, both in terms of my handouts that I think Barry made available to all the attendees, as well as certainly on my website. And I'm a resource and happy to interact with anyone that might have any questions whatsoever. With that, let me say thank you, and let me turn the floor over to Aaron.
So, welcome. Hi, everyone. I'm Aaron Futterman. And, my practice is effectively estate planning, elder law. I'm an attorney. I'm a CPA. I've been doing this for about 25 years. And there's been some significant changes that I hope to get to talk about. I'm a little anxious because there's so much to talk about, and I've I don't want to rush and trip over my words with so much to speak about. And I'm not necessarily familiar with everyone's level of familiarity with the rules. So I'm going to do my best, and I'll answer any questions at the end, and I'll always make myself available if there are questions after the fact. You'll have my number to call anytime. All right, so I'll try to go a little bit with the PowerPoint, although what I'm going to talk about really, I hope, is Medicaid and how it pays for someone if we find our loved ones in a skilled nursing home, or if we find our loved ones, our spouses, mom, dad, in need of help in the house to keep them safe in the house. And I hope towards the end, I'll be able to explain what I call the perfect plan, which involves Henry and Henry's services and long-term care insurance. Okay, so let's see if I can go through this, right? So I always say when people come to visit me, they're usually one of two types of clients or prospective clients, and it's, type A or type B. And the type A client or potential client is the person who wants to plan ahead. They heard their friends did something. They know they should be doing something. Maybe they've done some simple planning in the past, but now they're getting older and they have some new worries and concerns. And, I love working with these people because they recognize the value of planning ahead, because quite frankly, this is one of these unfair areas of the law where, someone gets unlucky and needs help in a nursing home. The people that were wise enough to plan ahead and could sit with their attorneys can arrange their affairs so that the financial damage is minimized. Of course, there's also the type B client where there's some crisis and there's an emergency and something happened and now we're scrambling. And I have such sympathy for these people because, I've been in it myself personally. And hopefully I'll be able to tell you a very personal story of how I, started doing this on my own, and it'll all hopefully come together if I have time. So, it's always more exciting to talk about the type B. There's a crisis. And the crisis usually is something like this. I'll get a phone call from a spouse or a child. Aaron, I got bad news. My wife, she fell ill. She's in the hospital right now, but it's a horror show. And I go, well, what do you mean? And the healthy husband says, look, my wife took a fall. She landed right on her head. And it's a horror show because from the neck down, my wife is healthy like a bull. Her pressure is great. Vitals are strong. She's going to be alive for a long, long time. There's no plug to pull. She's alive. The problem is from the neck up, it's not her. It's not my wife anymore. She doesn't recognize me. She doesn't know who the kids are. She can't even do the simplest of tasks. She can't feed herself. She can't shower herself anymore. And they're telling me at the hospital they're going to be releasing her to a skilled nursing home. And the nursing home is going, how are you paying? And of course, this is the big fear. And, it's overwhelming. I see the stress and anxiety. I mean, you have these people who have a loved one, a spouse, a mom, a dad that's fallen ill. There's all sorts of information from the doctors in the hospital, and there's all sorts of frustration and confusion. And then on top of that, if there is the nursing home involved, you got bills and costs and insurance, and they're tilting, they're going berserk. So I always feel good about what I do as far as my part of trying to help out even in a crisis. So the first question I always ask when I'm speaking to the healthy husband or the son for mom is there a power of attorney? And I'm hoping, I know I'm talking to attorneys, and I know that some of you have some familiarity, some of you may not, with estate planning and, elder law and Medicaid planning. But I can't tell you how many times people will come to me and I'll speak with people and they'll ask, well, what's the most important thing I need to do? And they kind of expect me to say some kind of fancy, expensive, trust. And, we do trusts, and we'll talk about them. Hopefully we have time shortly. The reality is the most important legal document that our clients need to have in place, power of attorney. And I know there's a slide somewhere coming up about powers of attorney. And I'm hoping that everyone here has a little familiarity with the power of attorney, which is the document that creates a principal-agent relationship. Hopefully the husband's telling me his wife, the principal appointed him the agent to help her with her financial and management affairs. And I'm hoping it's not limited. It's allows the husband to do unlimited gifting, what we used to call in the not so recent past, executing the statutory gifts rider, although, we've gotten rid of that and we've updated things. And we've also gotten rid of some rules regarding the exact compliance with all exact letters, and there couldn't be any misspellings in our forms and everything. And it's gotten to a substantial compliance with powers of attorney. So the banks couldn't refuse us if there was a typo or something. In any case, power of attorney, most important legal document. Because quite honestly, if the husband were to say, my wife's in the hospital, she's going to the nursing home, I would say, listen, I'm sorry, I'm not happy about this, but here's what I want you to do. I want you to get everything from that's in your wife's name alone or joint with you. I want you to transfer it all out. But I want you to transfer it all out just to you, healthy husband, not to you and your son, not to you and your daughter, just to you. And if you do that and you make your wife destitute today on August 11th, next month, September 1, your wife is eligible for Medicaid to pay the nursing home bill. And then the husband usually gives me a look like he starts looking out of the side of his eye. What? Wait a minute. I don't understand. I thought I thought there was some kind of 5-year look back and such. And then I say, you're right, there is. Let's talk about the rules of Medicaid and how Medicaid becomes available to pay for someone in a skilled nursing home. But let's also walk back and say, well, what's the costs of the nursing home? And, the nursing home, I just saw a bill for a nursing home here on Long Island in Kings Park, and the nursing home daily rate was $690 a day. And I did the math, and that's over $20,000 a month. So you can imagine the people's heads blowing up. Their wife is being released to this place. She may never come home again. It might have been a sudden accident or illness that caused this situation. Now, on top of it, he's being asked to pay a bill of $20,000+ a month, right? I mean, surprisingly, it surprises me how often I don't hear about these heart attacks or anxiety or panics. In any case, I would say to the husband, get everything out of your wife's name, transfer everything to you. Next month, she's eligible. And he goes, how's that possible? Well, here's how Medicaid works. What we're seeking is chronic care Medicaid. And chronic care Medicaid is available if the applicant passes 3 tests. Number 1, you have to be in the nursing home with a medical need to be there, right? This situation presents itself. I hope it never happens, but it does. Number 2 of 3, you have to be financially eligible. Now, what's that mean? Well, this year, financial eligibility means that the applicant could have assets or resources in their name no greater than $16,800. This is the poverty line, right? Because Medicaid only pays if the applicant or person has no other means to pay. They're the payer of last resort. And you're considered poor or needy if your assets, this is not income, we'll talk about income shortly, if your assets do not exceed $16,800. And we'll talk about that in a minute. I'll tell you the third test. The third test, the third of 3 to qualify for Medicaid is in fact the 5-year look back transfer penalty rule. But let's go back to test 2, the asset test, 16.8. So most people go, $16,800. That's not much. Do they count everything? Answer, yeah. Yeah, they count everything. But there are 6 exceptions. So there are 6 things that the applicant could own that don't count when determining if they're above or below the 16,800 threshold. And they are, number 1, personal effects. So, the wife's jewelry, her clothing, her fur coat, they're not interested in that stuff. She can own her personal effects, no worries. Number 2 of 6 things, the applicant can own 1 automobile. So if, wife has a car, the title is in her name. I don't care if it's a brand new Cadillac. The reality is, so long as it's not like a collector's car, the reality is 1 automobile doesn't count. Number 3 of 6 things that don't count, the applicant can own a burial plot. And I always say, isn't that nice? They let you keep your burial plot. But look, it does have a value. We, pay for these things. The reality is that whatever it's worth doesn't count against you when you're determining eligibility. Number 4 of 6 things that don't count, kind of related to number 3, you can own a prepaid funeral trust. And the prepaid funeral trust is something that you arrange at the family funeral parlor. You go speak to the funeral director and you say, look, if you want to do something nice for your family, you say, look, I want to get my affairs in order. I want to prearrange things. I want this kind of casket. I want this kind of lining. I want flowers. I want prayer card. And he's checking off this thing. And he's like, all right, that's $10,000 or whatever it works out to. You prepay and you prepay your funeral. By the way, the applicant could also prepay for other family members, and it doesn't count when we're talking about the look-back penalty rules. But whatever you set aside, Medicaid doesn't count it as an asset against you. Number 5, this is where it starts to get interesting. So the first 4 things, if you own it, they don't count. Number 5 is one that's a little tricky and surprises a lot of people, and that is qualified retirement accounts. So these are like your IRA, your 401k. Now, this is a little different. It's not just simply they don't count. It's you have to do something affirmatively with them at the time of application. It's not something you do prior. At the time of application, if you turn these qualified retirement accounts into a monthly payout status, if you do that, Medicaid will not count the principal balance from counting against the applicant. So by way of example, if mom goes into the nursing home, or wife goes into, mom goes in, son calls me, says, Aaron, my mom's going into the nursing home. What do? I said, well, let's see if Medicaid's available. I asked the son, what does mom own? Well, the only thing my mom owns, she rents her apartment. She doesn't own a house. She has this IRA. It's worth $100,000. Well, if we were to apply for Medicaid right then and there, they would deny her for being over-resourced. But what we can do is call, again, assuming the son has power of attorney and can speak on mom's behalf, call the broker, say, listen, I know mom's getting that one time a year, she usually gets it in December, the required minimum distribution. This is an IRS requirement that she must take each year. If we call the broker and tell them, listen, stop paying mom once a year. I need you to start paying mom a certain amount each month. And of course, this amount will at least meet and always exceeds what the minimum distribution is, because we're looking at a table that we must use in order to satisfy Medicaid. And we turn it into a regular monthly income stream. The principal balance of that IRA wouldn't count against mom. Now, understand that every month that mom is on Medicaid, it gets a little bit less and less each month, but mom passes having been on Medicaid in the nursing home, and this IRA has beneficiaries. The beneficiaries will take whatever remains in there, and there is no Medicaid claim or lien that's on that retirement account. So the 5th thing. The 6th thing that doesn't count, and this one surprises people. I don't know why it still does. And this is the primary residence. Now, so the usual, son calls me, mom's going to the nursing home. What does mom own? The only thing mom owns is the house. And I go, okay. And I go, it's mom's primary residence? Yes, it's her primary residence. And I go, well, how much is it worth? And the reality is, they usually say, well, look, we were looking to take out a reverse mortgage. We had it appraised. The appraisal came in at $750,000. I say, okay, it's $750,000. It's her primary residence. Well, the reality is that we could apply for Medicaid right now. Medicaid will start paying, next month. And again, the son looks at me like, what? I just told you that my mom owns a house worth $750,000. She's eligible for Medicaid. I go, yeah, it's her primary residence. They don't count against her. I always have to say, though, this is a trap. This is the trap. And I'll tell you where I see this come back and haunt people. The trap is that Medicaid will pay, but Medicaid will put a lien on that house. And every month that they're paying the nursing home, that lien, of course, gets bigger and bigger and bigger until one day when mom's in a better place, Medicaid is going to sue the estate and force the sale of the house to recover the cost from the house that they paid for mom during life. Now, understand, if mom's been in there for years and years and years, it's possible that the equity in the house is gone. It's possible also that if there's a lien on the house and mom was in there for, a year, all right, well, when the house is sold, some of it will be paid back to Medicaid or the Department of Social Services, but the balance will go to the ultimate beneficiaries. So it's a trap simply to say that the house doesn't count. And where I often see this, and it's kind of sad, is where families overwhelmed, they're entering the nursing home. The nursing home, of course, has a concern that they're taking care of someone, they want to get paid, and they have people at the home that will do applications for them, and they'll get their, patients, clients on Medicaid, and they won't necessarily plan with the house, and the family doesn't know that there's a lien building on this house, and one day when mom is gone, all of a sudden they're getting sued, and they never realized that there was some kind of payback in the future. So it's a trap. But so to recap so far, to qualify for Medicaid, you have to be in the nursing home. Medical need to be there. You have to appear needy or poor, less than 16.8. Everything counts against you, but for the 6 things that we just mentioned. Now, here's something, and I know that I've spoken, with Henry about this in the past. One of the things that's a trap for people when they're applying for Medicaid and what counts against them, people don't realize whole life insurance policies. The way Medicaid views a whole life insurance policy is that if you own a whole life policy, there's a cash surrender value. Medicaid, being the payer of last resort, expects the applicant to cash in that policy and use the money on their, you can cash it in for $100,000. Why are we paying? Cash it in, spend it on the cost of your care, come back to us when you're below 16.8, and we'll reconsider getting you on the program to pay for your stay in the home. So the other thing I want to warn people about is sometimes people hear about annuities and annuities not necessarily counting. It's very rare I've seen someone own an annuity that doesn't count against the applicant when determining if they're poor or not. So just be careful when you're speaking with your clients, and if you're not sure, you could certainly ask me or Henry, and we'd be able to help you out. Okay, so the 6 things, couple things to keep in mind: life insurance, annuities when advising clients. Of course, the third test for Medicaid eligibility, that's the 5-year look back, and the 5-year look back transfer penalty rule. Well, what does this say? Well, when someone applies for Medicaid, Medicaid does an audit of the applicant and the applicant's spouse, and they want to see all the financial records for the immediately preceding 60 months. They want to see all the bank statements, investment statements, tax returns. They want to see everything that's been going on in that couple or individual's financial life for the last 60 months. So we have to submit it. If we can't get it, and they'll deny us for lack of records. So you're going to submit it. It's worth, 15 to 20,000 a month. It's funny. I remember when I started doing this and I saw that first bill when it came in, and I was a little shocked that it was a woman who was particularly unhealthy, and the bill worked out to about 20. It was like 700 a day or more. And I remember thinking this was early on in my career, I said, if this ever happens to me, 700 a day, just, throw me in the Waldorf Astoria, 700 a day. I mean, to live in this place. So I remember it's funny how, you pay a lot of money. And if you visit these places, it's hit or miss sometimes. There's no secret, wonderful nursing home. They're all about the same, and it's sad. And the worst part is our loved ones being there, falling ill and needing it. And then, of course, financially having to pay, $500 to $700 a day is devastating. But back to the third test, the 5-year look back, they're looking to see if the applicant gave things away. They're looking for what Medicaid calls uncompensated transfers. So what happens if they find a gift in this 5-year look back? Well, Medicaid imposes a penalty. Well, what's the penalty? The penalty is a period of time that the applicant is deemed ineligible. And by the way, if it's a married couple and if the spouse gave things away, that punishes the ill spouse from being eligible. So sometimes people try to be clever and say, well, we transferred everything. When mom really made, dad, healthy husband really made the gifts, not mom. And well, you're considered one unit and they'll look at all the records. But nevertheless, if you make gifts, you get punished. What's the punishment? Well, they take the total gifts and they divide that by something called the regional rate. Now, New York State is broken up into 7 regions for purposes of Medicaid. And New York City is one of the regions. And each year, every region is given a rate that's supposed to represent the average monthly cost of being in a nursing home in that particular region of the state. And in New York City, and I know that's my audience today, the regional rate is $13,415. It's quite honestly, that's low. That's not the real average, but that's what they use. So if someone had given away over the last 5 years $100,000, they would divide that by 13,415, the New York City regional rate, and the quotient, 7 point whatever it works out to, let's just say 7.45. Medicaid effectively will say, look, for about 8 months, rounding up, they'll say 8 months. Don't look to us. Your wife had $100,000. She decided to give it away. Why are we paying for 8 months? You figure out a way to pay. We're not paying, which of course, dispels a myth that people have, which the myth being that Medicaid takes things. And quite honestly, Medicaid doesn't take anything. Medicaid just simply denies. We're in the nursing home. We need help. And Medicaid says, don't look to us. Why? Because you made gifts in the immediately preceding 5 years. Of course, gifts made beyond 5 years ago, that's fine. And that's why, hopefully the people that come in my door are the type A clients, the ones that plan ahead. But so to recap, to qualify for Medicaid, you have to be in the nursing home, medical need to be there. Number 2, you have to look poor, 16.8 or less in assets. Number 3, hopefully you haven't made any gifts in the last 5 years. If you have, you'll be punished for a period of time. Of course, that varies based on how much you gave away. Now, with any rule, there's always exceptions. So some exceptions to the rule, and I think I have a slide here. I'll try to flip through. All right, I just says exceptions, sorry. Exemptions, I should say exceptions. In any case, the exceptions, the biggest one, as we kind of talked about before, and why the healthy husband's head was blowing up and didn't understand when I said transfer everything to himself. Biggest exception, transfers between spouses, totally safe. So if the wife transfers everything to the healthy husband, because the healthy husband has that power of attorney, next month, September 1, the ill wife is on Medicaid, no worries. And of course, that leads to some other things. But truth be told, people blow up and they're spinning. And I go, yeah, that's right. But make no mistake, now that the healthy husband has all the assets, there's some things to consider. The first thing to consider is we got to make sure that healthy husband's plan is rearranged, because I usually do, my Johnny Carson and the Karnak, and I go, everything to the wife, what is in the husband's will, right? The fear, of course, being that if the husband, now that he owns everything, gets hit by the bus while visiting his wife in the nursing home, everything might go right back to the ill wife. Guess who's off Medicaid? And, instead of the kids, perhaps inheriting something, the nursing home is getting paid privately now. So exception 1 to the 5-year look back transfer penalty rule, transfers to a spouse. Exception 2, and I always ask this question, is transfers to a disabled child. Now, I say disabled child, and it has a very specific definition, and that is a child that is eligible or receives Social Security disability. And long story short, this is the personal story that brought me into this area of the law. My background is I'm a CPA, and when I was working as an attorney to begin with in my career, I helped very wealthy families save taxes and estate taxes. And it was built for it. I was an attorney, I'm a CPA, that's what I did. And of course, something happened in my own family, my grandma, and my father calls me and he says, Aaron, I've been taking care of, grandma in the house. I go, I know, Dad. And my dad did everything possible to keep my grandma safe in the house. He moved her in, refitted the furniture, handrails, special bathtub, and he did everything he could. And unfortunately, she kept falling and she needed to be in the nursing home. It was the safest thing for her. And my father said, you got to help me get grandma on Medicaid. I said, Dad, I don't know what I'm doing. He goes, you're the family attorney. I go, Dad, I have no idea what I'm doing. I help wealthy people. But I said, I know that this attorney has the reputation of being the elder law expert. Why don't you go speak to him and see what he says? But Dad, let me know what he says. I'm curious what the strategy is. So my father went to see the attorney and he came back and he reported to me what the plan was. And basically we were going to lose everything. And I remember thinking, you're kidding me. This is what happens to a woman who was the wife of a veteran who paid her taxes every year, saved for a rainy day. This is what happens to our elderly when they get sick and now they need the nursing home. I found it incredible. And, being an attorney, as we all know, we have the ability to do a little research, and we looked at the statute. I looked at the statute and I took a look around, and I found that, at the time it was a 3-year look back. I saw you had to be poor. I said, why don't I just give everything to Dad? He's the only child of my grandmother. And then I saw that there was that look back penalty. It was 3 years at the time. And then I saw exceptions. Oh, great. And I saw a spouse, and my grandmother was a widow. And then I saw disabled child. I go, what's this? And truth be told, my father used to work at Tower 2 of the World Trade Center. And he was there back in 1993 when that truck bomb blew up in the basement. He was on the 20th floor. And he had a pretty bad heart attack as a result. It was a miracle they got him to the hospital, and he had to have a defibrillator. He lost a lot of capacity, and they put him out on disability. Now, if you met my dad, God bless him, he was a slim man, never smoked, never drank, and you would never know he was, outwardly disabled. But technically, he was out on disability. And I said, Dad, I think you're a disabled child. I think grandma could transfer everything to you next month. And I think she's eligible. He goes, what? And I showed him the law. And we go, let's give it a try. And we gave it a try. And we did it. And I did the application. And grandma got on Medicaid. And, within the next couple of weeks, I told my boss, bye-bye. Because I knew intuitively that if the expert didn't know, or more importantly, in hindsight, didn't ask the right questions, my father didn't seem outwardly disabled. I can't tell you how many times I've had situations like this where a child had a heart attack, something that's not obvious. So you got to ask the question, if there's a disabled child, everything could be saved. All assets were transferred to my dad. Next month, grandma was eligible. Did they see it in the look back? Sure. I showed the disability award letter, game over. Second exception to the look back transfer penalty rule. The third exception is a more narrow exception. I don't have time to really get into it because I want to hit on a couple of other things, and that is the caretaker child exception. A parent who's going into the nursing home can transfer a primary residence to a child that's moved into the house with mom to help them out if they've lived there for the immediately preceding 2 years. And that transfer, even though it would be seen in the look back, it doesn't punish the applicant. And then there's another exception. If someone's going into the nursing home and the choice is either give it to the nursing home or set up a trust for a disabled family member, someone other than a child. By the way, the question that always comes up is, could it be a son-in-law, a daughter-in-law? It's got to be a child of the applicant. So the other thing that we can do is set up a sole benefit trust, that we transfer things to for the sole benefit of this disabled person. And with this trust, that transfer wouldn't punish the applicant. The trust has to be designed in a certain way to only benefit that disabled person. And if there's a balance in that trust, when that disabled person, the recipient of the trust, the beneficiary of the trust, passes on, that gets paid back to the state. There's a payback provision. So, that's chronic Medicaid. The other type of Medicaid, and this time is just flying. There is community Medicaid. And I want to make sure I talk about this because this is where some big changes are coming up. And community Medicaid, if you're not familiar, is another type of program in New York State where if you have a loved one that has some needs, but not necessarily to the level of needing nursing home care, Medicaid is available to pay an agency that will send a home health aide to the house to assist with what Henry alluded to earlier, or explicitly stated earlier, help with the activities of daily living, bathing, clothing, transferring from room to room. They'll do like cooking, cleaning. They're not nurses, so they wouldn't administer medicine shots, but they can remind people to take their medicine. By the way, there's also a program within community Medicaid called the Consumer Directed Program. And maybe you've seen these TV commercials. Have your loved one, paid to take care of your parent. That's community Medicaid. I'm looking at this slide. I'll get back to it if I can. In any case, community Medicaid will pay for these home health aides. To qualify, the rules have been, for as long as I've been doing this, for almost 25 years, the rules have been, you have to have a need. That need gets determined by a visit from a nurse from Medicaid. We send papers from our client's doctor with the diagnoses of conditions and such. And usually what my office does and what we do is send one of our social workers out to advocate on behalf of our clients to try to get as much time in the form of a number of days a week to help keep that person safe and satisfy the concerns due to the illnesses and issues of the person that needs help in the house. So you have to have a need. Number two, you have to be financially eligible. By the way, same definition, assets less than 16.8. Test three, this is the big one. Test three, for as long as I've been doing this, and people used to be shocked. I used to say, you know what the look back period is for home care? They go, what, 7 years, 10 years, 4 years, 0. Meaning, and people, what? I say, yeah, mom who's ill could transfer everything out of her name today, make herself poor. Next month, she's eligible for home care. And people would be, what? How can that be? That doesn't sound right. I go, yeah, that's right. She can transfer everything out of her name. There's no look back penalty for community Medicaid. And the logic was, long story short, is that the state felt it was cheaper and more efficient for them to pay for home health aides, have society pay for home health aides for this ill person to prevent them from falling in the shower and having society now pay for them in a skilled nursing home. That was the logic. The big change that's coming up Perhaps October 1 for applications made after October 1 is that there will now be a 2.5 year or 30-month look back transfer penalty for home care. And it's the same calculation as it is for the people in the nursing home, chronic care Medicaid, where they take the total gifts divided by the regional rate. The quotient is the number of months that the person is ineligible from receiving help in the house. Presumably starting October 1, it may be pushed out. It all has to do with when public health emergencies expire. So, it's a little unsettled at this moment. It's kind of settled, but it's a little unsettled. And it's a little tragic too, because it used to be a very great program, relatively straightforward to take advantage of. The last thing I want to talk about is income, and I want to talk about it in both programs. So what happens to someone's income when they're on Medicaid? Well, by the way, before I tell you about income, I want to also say the other change that's coming up with community Medicaid is in the future, when the new rules become effective, and by the way, they should have been effective, but then the pandemic hits and kept pushing it off, is that it used to be you had to show a need with one of the activities of daily living. Now you're going to need to show the person needs assistance with at least 3 ADLs, activities of daily living, unless they suffer and have a diagnosis of dementia or Alzheimer's. So it's going to become harder to prove that someone has a need in the house. Nevertheless, back to income. So what happens to someone's income when they're on Medicaid? Well, if we're on chronic Medicaid, the type that pays for the nursing home, if it's a widow or widower or a single person, Medicaid expects that all of that person's income to be turned over to the nursing home every month. What's showing here? If you turn it over, they'll pay the difference. Medicaid will pay the difference. I'm seeing a question here. Does that 30-month look backward? I think I answered that question, I think. I'll try to save for later any other questions. If someone has a healthy spouse in the community, what happens to that person's income? Well, this brings up the concept of, what the well spouse is entitled, and this is called the minimum monthly maintenance needs allowance. It's a well spouse's monthly income allowance, the minimum monthly maintenance needs allowance, the MMMNA. And this year, the income allowance for a healthy spouse is $3,435. $3,435. What am I talking about? Well, let's say the ill wife who's going into the nursing home is $2,000 of her own income, Social Security, pension, whatever the heck it is. The healthy husband has, income $2,000 of his Social Security pension, $2,000. Wife is going in. Well, $1,435 of the wife's income can be added to the husband's income to bring him up to the $3,435 a month. And now the difference will go to the nursing home each month on behalf of the wife. Medicaid will pick up the difference. So, the reality is it depends on what's going on. Now, if the healthy husband has income that exceeds that, theoretically he has to contribute, 25% of the excess. I'm seeing people. Am I supposed to be signing off sometime soon? I'm this double screen and everything. How am I doing?
You got about, we've got 7 minutes left.
Okay. All right. Now, if someone is on community Medicaid, what happens to someone's income is if it's a single person this year and they're over the age of 65, they're allowed to keep $934 a month. Anything above that, effectively that gets turned over to Medicaid, and consider that the cost of all the help that we're going to provide in the form of home health aides or paying for your family member or loved one at home. So, how is someone expected to live in New York on $934 a month? So what this brings up is the concept, and maybe some of you are familiar with it, and that is a pooled trust. And I always tell clients, because they hear trusts and everything, and I hope to talk about trusts in a minute. A pooled trust I always describe as kind of like a fancy bank account, but you can't set this up at Chase or Citibank. It can only be set up at certain not-for-profit or charitable organizations. The idea being that you set up this account, whatever the excess monthly income is, you deposit it into this fancy pool trust account. They take out a nominal management fee, but whatever's left each month is available to pay that person's expenses. What it boils down to is it's a complicated kind of weird way for someone to be on community Medicaid, have home health aides paid, and still be able to use the supermajority of their income each month on their expenses. I say supermajority because there is a management fee. Anyhow, so let me go back to the beginning with type A clients. And now, Henry, forgive me, is it 5 more minutes before the end? Do we got to have time for questions?
Yeah, that's in total. We've got 5 minutes left for questions right now.
5 minutes for questions or until questions?
No, 4 questions.
All right, real quick then. I'm having a hard time hearing. I think I caught you though, Harry. Forgive me. Henry, I'm having a hard time hearing you. In any case, real quick, when people do planning, what do they come in most often for? Trusts. What's the type of trust that helps? Irrevocable. It scares people. They hear that word, they think what it means normally. And I have to explain to people that, yes, it's called irrevocable, but you can revoke an irrevocable trust, and they're usually stunned. And I go into the reasons why the trust makes a lot of sense. If it's designed right, the reality is, and I can't get into it because of lack of time, I'll be happy to answer any questions. The reality is, if it's designed right, the trust protects people's assets. And if it's done timely, more than 5 years before an incident, that family wins and they still maintained control. And that's the key with the trust planning for people, because there's always that delicate balance between want to do good for the family, want to protect my stuff for my kids, my grandkids, but in the same breath, I don't want to be out of control of my things. And the trust is the best solution for that. All right, we got a few minutes for questions. I apologize.
So, Barry, any questions in the queue there?
I'm having a hard time hearing you, Henry.
Okay.
I can read the question. Does a 30 months look back regarding community Medicaid? We don't have the rest of the question.
Well, yeah, I mean, community Medicaid will have a 30-month look back, presumably for applications made after October 1. So I got people scrambling to come in here now that have been on the fence, whether to contemplate it or not, where right now, people who get the applications in, no look back. It's possible after October 1. I suspect it's going to be next year, but, someone's hand slipped. Have to be. It's not that the gifts and the application, right? Before, the gifts have to be made before. Yes. So I'm sorry, Susan, the question, sorry. So the gifts have to be made before. That's right. So when you make an application, hopefully for home care, mom or dad made the gifts more than 30 months ago, if that answers the question.
CLE code LTC 194 LTC 194.
Okay, and is NAMI considered before or after the applicant has active chronic care Medicaid?
Is NAMI for the net available monthly income? Is it considered before it? Well, again, that person has income. I'm not sure what they're driving at. The reality is the monthly income for the person is expected to be turned over to the nursing. I mean, I guess technically there's a $50 personal needs allowance that goes into, an account where the men get a haircut, the ladies, get a hairdo done or whatever. The ladies say, $50 haircut, for a hairdo. I mean, what do I know? Henry and I, we get like, $12 haircuts. What do you want from us? I don't know about ladies' hairdos.
But Aaron, you mentioned the word advocate before, and just what comes to my mind is the importance of what we can really do for a client, which is to advocate, not just for the client that's sitting in front of us today, but for the client that's going to be sitting in front of us 10, 15, 20 years down the road, and have that client realize that one day he or she or they will be that client.
I'll tell you, the perfect plan for people that want to make sure that, their hard work, their assets go. I always say it's a combination of Henry and myself. The perfect Medicaid plan, quite honestly, is make sure you have a long-term care policy that could pay for at least 5 years. If you have that and have the power of attorney and you're golden. Why? Because if something happens to you, right, the kids call me and say, hold on a minute. Before you call Henry and tell him to get in touch with the insurance company, get everything out of mom's name. Get it all out, right? Transfer it into her trust, get it all out. Now call Henry and have them start paying for 5 years. 5 years go by, mom still needs help. The policy is run out. All right, now we'll apply for Medicaid. They look back, what's happened? Nothing. 5 years and a month ago, that's when we shifted everything out of mom's name. It's the perfect plan. It's a combination of things, and you have to explore these with our clients.
That is one of the most significant things that you've said. It happens to be something that I mentioned earlier, and that's a matter of managing your risk. Do you want to just keep the policy in force for the 3-year look back, or 30-month look back, or 5-year? You can keep it for as long as you want. But if you just want to limit premium for those 5 years, that's a bulletproof plan, because you're far better off, paying for 5 years of premium rather than 5 months, let alone 5 years of cost in a nursing home.
Yeah.
The ratio of risk to reward is significant enough for a person to take it.
Yeah. No, I agree. The people that plan ahead, right?
Yeah,
like the old army, the 6 Ps, right?
You can't. Yeah. Like we said before, you can't take away the emotional hurt or the medical hurt, but you sure as hell don't need, on top of that, to add on the financial and the legal at the absolute worst time. Just plan ahead. And the costs, talking about long-term care costs, you can't buy it beyond 875. So keep that in mind. Individuals sitting on that, 74, 75, right now they've got a choice. Beyond that, there is no possibility. A pandemic took away an awful lot of options that were available in the insurance industry and long-term care industry that have simply not come back. So 75 is the age, is the deadline, so to speak. Advocating for a client and letting that client know what is ahead of him or her is so important.
Thank you for that great presentation.
Right. Thank you.